So we are finishing off with the notes to the financial statements, and that will conclude our entire series on how to read and interpret financial statements. So this is going to be a fairly short video, just because there is a lot of variations of what content and subject matter might go into the notes of the financial statements. So if you want to kind of remember this phrase, or just think about this phrase, financial statements themselves, that's to say the income statement, the balance sheet, and the cash flow statement. Those are the financial statements, right? So they show the numbers, and the notes to the financial statements, which comes after, at the end of the set of financial statements, at the very end, the notes will explain the numbers, if they need explaining, that is. There's not always, it's not going to explain every single question you might have. Some of the things you might have to go back to the client about. But any good, sophisticated client, or if they use a sophisticated accounting firm, will provide some additional details. So what can you expect in the notes to the financial statements? Well, there's a lot of different things, but generally, it'll probably give you a breakdown of the policies, so the accounting practice that's used or how they calculate the numbers. It might give you a breakdown or some additional details onto some of the bigger balances on the financial statements. Most commonly, there might be a schedule or breakdown on, let's say, cost of goods sold. Usually it's just a one-liner, but it could break it down into, for example, going back to the lemonade stand example, on this income statement, there could just be a one-liner that says, so you have, revenue, and then you have cost of goods sold, right? And then you have gross profit underneath. It'll just show it in one line. But then if you have a note, so it'll always refer to a note, like note 1. And then when you flip to the very end, note 1, it'll just be 1, and it'll say cost of goods sold. And it'll break down each of the items, like it'll say maybe for lemonade, and it'll be water, lemons, and sugar. Okay, and it'll tell you how much each of those make up the cost of goods sold. Another very common item that gets broken down is the PP&E, plant, property, and equipment. There might be a one-liner, but when you look at the breakdown, it'll tell you how much of that is attributed to property, like a building or land or vehicles. Okay. And then finally, you have some extra info. So they might want to give you some additional context. Like, for example, if you have a due to shareholder or due to related parties, remember in distributions, the notes to the financial statements might clarify who that shareholder or related party is. It might say, this related party is, XYZ company, right? XYZ company limited. Or it might say, oh, this related party is actually the family of the CEO of the company, something like that. So before we start with this example, we're just going to put a little divider in the middle, because on the left side you have the balance sheet, and on the right side you have the notes to the financial statements. The reason why I'm showing both of them is because when some line item on either the income statement or the balance sheet, I know I only show the balance sheet, but this could also apply to the income statement. If there's something like this in parentheses that says note 1, note 2, note 3, or note 4, you know that at the end of the financial statements, you can expect to find this set of notes to the financial statements. They'll also be numbered in correspondence to whichever note is being referred to, and it'll also tell you exactly which account it's referencing, right? Just in case you forgot. So you see here, accounts receivable, note 1, it'll say 1 accounts receivable. So this note applies to this line item. Sometimes there'll be notes that don't apply to any line items. It'll just tell you how, it'll just give you some additional context or policies that were used without referencing any line item. But those are usually things that you might not have to read into detail. It depends on the situation, of course. So the one key takeaway is the notes are there if you need additional information. You don't always need to use the notes. And of course, for commercial banking, the smaller sized mid-market companies might not even have a note to the financial statements. So what ends up happening sometimes is you always have to ask the accountant or the business owner to give you the information you need from reading the financial statements. All right, so let's just take a look at what that might look like. First, for accounts receivable, it tells you how in 2025 and 2024, how they actually got to the balance that you see on the balance sheet, the 80,000 and 66,000 for the 2 years. You see it corresponds exactly here on the left side, but it tells you how they calculated it. So they start with trade receivables. So anything that their clients, the company's clients, have bought but paid in credit. So that's a receivable that the company can expect to receive in the future. Like a credit card, right? So when you buy something on credit card, you owe a company a payment in the future within 21, 30 days. But it deducts this thing called allowance for doubtful accounts. So that's actually quite common. What an allowance for doubtful accounts is essentially people who buy products or services on credit. There's always going to be a proportion of them that don't end up paying. So this account is usually the company predicting how much of the accounts receivables are not actually receivable, like they're never going to collect it. And that adjustments get baked into the final number. That's why it's called a net receivable, because it takes out the allowance for doubtful accounts. So that's very informative, and you could even look year over year whether the allowance for doubtful accounts increased or decreased, or what's the trend there. And what you could do with that information is, it could set off red flags like, hey, if the allowance for doubtful accounts is so high, like who are you selling to that's not paying, right? So information like that could be really insightful and help you detect red flags in a business. For inventory, it's a little bit different. So you have, again, this is a little error. That's not receivables. This is inventory. So you have the 80,000 and 70,000, which corresponds exactly to the left side, but it tells you the composition, what makes up the inventory. So it tells you that in 2025, there's 30,000 that's raw material, and then there's 50,000 that's finished goods. So raw material would be like, in the case of a lemonade stand, it would be the lemon, just the straight up lemon, straight up sugar, straight up water. And then the finished good would be once you use your manual labor to put all three of those together into the lemonade, that would be the finished good. So it just kind of tells you the composition of the inventory, and that might be insightful for other reasons, right? And then one of the most common things that you'll find in the notes to the financial statement is more information about the plant, property, and equipment. Specifically, it'll tell you what the accumulated depreciation is, or accumulated amortization. So I would say probably it's going to be called amortization, because like I said in one of my other videos, depreciation is more for like intangible assets like IP, copyright, stuff like that, whereas amortization it applies to fixed assets like buildings, equipment, machinery, right? So this is really useful because the accumulated depreciation gives you kind of an inkling as to when a business might need to replace its some of its machinery. Like if the cost up here, if the cost, like let's say the cost was 300,000 for a particular equipment, and then the accumulated amortization is 250,000. So you know it's almost completely depreciated or amortized. You know that the company will probably have some capex or capital expenditures coming up in the near future, right? So that's some kind of insight that you can gain from it. And then lastly, the debt is something that's really useful. When you refer to the notes, it'll tell you, I mean, the loan balance isn't important, but it might list all the different loans. If there's more than one loan, it'll list them all out. So you know, like, hey, this 90,000 or 120,000 on the long-term debt is comprised of, let's say, just in theory, comprised of a bank loan, a car loan, et cetera, a mortgage. And then it'll tell you in a paragraph format information about the loan itself. So in this case, it says the company has a TD loan. So if you were not working for TD, for example, if you were working for another bank, let's say RBC, you'll know that this company already has a loan with your competitor. That might be useful information, right? It tells you the interest rate. So hey, if they're getting charged this interest rate and we want to bring them over, we probably have to charge them a lower interest rate, right? So another good source of intel here. Repayable in monthly installments tells you how frequently they have to pay the loan and maturing in 2028. So if they're locked into their loan and they can't come out of it, then you have another shot at this client when this loan has matured in 2028. That's when you can approach them and talk about their other financial needs. So yeah, that's kind of how the notes of the financial statements work. Use it at your leisure as you need it. Certainly the financial statements as a set of information is not something you need to use in its entirety. I would say just use it as efficiently as you can, but when there's information, like when you're looking into something, always take all the information you can, but obviously don't burn your calories looking into something that is not too important. And that's my advice for commercial banking in general when you do your analysis. So yeah, that concludes our series of videos on financial statements in general, and we're going to move into the analytical component. So there's going to be some ratios that I think if you want to get your foot into commercial banking that you'll be expected to know, and we're going to cover that. It's not a lot, so don't worry. I think maybe 1, 2, or 3 things that you have to calculate. The most important incorporates EBITDA, but we'll get into that in the next videos, which will be separate from this playlist, of course. Those videos will assume that you know all this information really well. So keep that in mind. I'm not going to go over that aspect with, kind of thinking that you don't know anything. I'm going to assume you know everything up to here. And yeah, thanks for sticking through all these videos. Hope it helps. And if there's anything you don't understand, feel free to reach out and I can go over with you one-on-one if you need.